Welcome everyone again to this ShareCafe Hidden Gems webinar. Now, what caught our eye this week? It would have to be, the acquisition by Vanguard of a fintech business called Just Invest. Now, this was Vanguard's first ever acquisition in its 46-year history. Now, Just Invest, the business that it bought, offers direct indexing or custom indexing, something I think you're going to hear a lot more about this in coming years. Now, custom indexing allows investors to buy an index and tilt those sector weightings to suit their personal needs. So, for example, rather than buying a ASX 200 ETF as a single trade, you buy the 200 ASX stocks to replicate that index. And then you may want to apply your own personal factors. Perhaps you have environmental concerns, so you can remove the oil and gas names within that index. Or you may want more income, so you can increase your exposure to dividend-paying stocks like the banks, for example, to increase your income. Or you may work at NAB for the last 20 years and feel like you've got enough exposure and enough risk within the banking sector. So you may be able to remove the banks from this personalised index. Or you're 25 years old and you want to tilt the ASX portfolio to tech stocks where you want to find more growth. So effectively, in the future, you'll be able to personalise and customise your index portfolio according to your personal circumstances and preferences. So if you compare this to an ETF, ETFs are really a one-size-fits-all approach. So custom indexing is effectively a technology. And we're only starting to see it now because of zero commission trading and fractional share trading. So now you can buy $1,000 worth of Berkshire Hathaway A-class shares instead of having to pay $421,350 for one share. Now, all this enables investors to own shares in their own name rather than through a managed fund or an ETF. And having shares held in your own name for tax purposes or tax harvesting allows an investor to realise tax losses within that individual index on certain shares when needed at tax time. So this all continues the evolution of the investment industry, where we kind of started at active fund managers, then the need for lower fees drove us to passive index investing via ETFs, and now to custom indexing, which is really driven by software that allows for increased transparency and better tax management. And it's not just Vanguard interested in this space. The past year has seen a series of acquisitions by major money managers such as BlackRock, Morgan Stanley, Goldman Sachs, and Charles Schwab. So this is all a clear sign that custom indexing may challenge ETF's dominance. So that's enough for my introduction. We've got an article we've just written on the subject called "Don't Like the Index and Create Your Own." That's on ShareCafe right now. Now, next week, we'll also be releasing through our research business some research reports on Kalima, a big one on Novonix, and also Trig Mining, so look out for that. All these webinars and the recordings can be found on our YouTube channel. If you want to ask a question, just type it in the Q&A box today. First up, we have Plenty Group, ASX code PLT, market cap around $250 million, hasn't been listed for 12 months. The company is an award-winning automotive, renewable energy and personal loans delivered by proprietary technology to help creditworthy borrowers bring their big ideas to life. We have with us the CEO and Executive Director, Daniel Foggy. Daniel, over to you. Thank you.
Thank you very much for the introduction, Tim. I might get you to turn to the next slide, which gives an introduction to our business. Basically, we looked at lending when we launched the business back in 2014, and we saw that traditional lenders can be slow, cumbersome, and often provided quite poor value. So we looked to reinvent lending from the bottom up. Me and my two co-founders, me with more of a financial background, them with both a software and a financial services background, set about building Plenty, previously named RateSetter. We've built the business very much with technology at our core, so that we can provide customers with a better experience and so that we can scale really efficiently. And I've got some great slides I want to talk through there in that regard. As Tim said, we listed on the ASX last year. We listed in September, and since we listed the business, we've been growing very strongly. Look, our purpose is about bringing our customers, our borrowers, bigger ideas to life, as well as our investors. And our mission is to build Australia's best lender, which sounds grand, but I really do think in each segment that we're already active in, we are doing extremely well and earning a great reputation in terms of being a very good, if not the best lender. Moving to the next slide. We operate in 3 different lending verticals. We started off in personal loans. We've diversified into renewable energy and automotive loans for 2 reasons. One, we really like the credit characteristics in those verticals, but also the scale of the opportunities. These are exceptionally large markets. If we just take the automotive market as an example, around over $30 billion of lending every year. And the dynamic there is that, like the other markets, you've got large incumbents that have been less focused on these markets, have been selling their loan books, Westpac being the most recent example, which is creating a real vacuum for businesses like ours to enter and build scale. I'll show you some very impressive growth on the next few slides, but despite that growth, our penetration in each of the verticals is very low, leaving a very large opportunity for us in the automotive market, around 1% market share in terms of originations. So a long runway for growth given the size of the markets we're in. On to the next slide. You see our growth there. The first 5 or 6 years of our existence was really about making sure we built strong foundations so we could grow very successfully. Once we did 2 things. One, got the right funding in place. We did that in February last year. We started funding out of some warehouse structures. We've now got 2 warehouse funding structures. And you can see the growth that we've experienced, particularly in the last year. In FY21, we have a March year end. We grew originations by 64%. And in the latest quarter, we released a quarterly result earlier this week. You can see that we have now hit $1 billion run rate in terms of loan origination. So exciting growth to be achieving there. On to the next slide. One of the things that we've really focused on as a business is building customer reach. This is the sort of thing that takes time, but builds a lot of value in a business. So we work with over 10,000 loan brokers. We work with over 700 renewable energy firms, be they OEMs like Tesla, or be they energy retailers or people installing solar panels and home batteries. So a large proportion of our loans come through these referral partners. We like that because we tend to earn very good economics when we're not paying marketing dollars, rather we're investing in a B2B relationship. We've also got very strong digital lending capabilities direct to consumers, which represents around 15 to 20% of our originations at any given time. We've also attracted, a universe or an ecosystem of over 500,000 customers, a number which is growing strongly. On to the next slide. I've got a little bit of information here on our 3 verticals, which I'll just touch on quickly. In automotive lending, we've spent a number of years investing in automotive specific technology, distribution, and building the right funding to put us in a place now where we can grow really strongly. Last year, we grew our automotive originations by over 300%, and the latest quarter, even higher growth than that year on year. So that's really reflective of us taking market share in a very large market. But as I touched on earlier, given the size of that automotive market, still some way for us to grow. We're just focused on offering consumer loans at the moment. We have just recently in May launched an offering for commercial customers as well, which really doubles the size of our addressable market in auto, giving us confidence around growth going forward. Moving on to renewable energy, you'll see some consistent growth there, but it's actually accelerated more recently on the back of us launching a buy now, pay later offering at the start of this year. So that has seen a good uptick in our originations over the last quarter in particular. As I said, we work with over 750 partners. We actually have the government by this Clean Energy Finance Corporation funding some of our loans. We run 2 government programs. So a very exciting and strongly growing part of our business. On to the next slide on personal loans. I think everyone will probably understand the dynamic that the banks are losing market share. Technology-led digital businesses like ours are benefiting from that. I think one of the things that differentiates us as a business is the fact that we do earn very good economics on our personal loans, given the fact that we've been in market for some time. We're very good at attracting the right customers from the right, one of our 33 different digital partners we attract our customers from, and have a very effective funnel so we can derive good or low cost of acquisition. On to the next slide. Obviously, as a lending business growing strongly, you need to make sure you're doing that without compromising credit. You will see the average credit characteristics represented here with the credit score on our portfolio are exceptionally strong. Average credit scores well into the 800s across our portfolio, which contrasts actually much higher than what the big four banks would have in their personal loan books, for example. Similarly, our 90 days arrears is exceptionally low, below 50 basis points, which we're very proud of. On to the next slide. We've talked a bit about technology, and I guess it's hard to emphasize how important that is. It's really what underlies our growth as a business. We own our own technology. We have 40 staff domestically and offshore that are focused on our product and technology. That is the key differentiator. Maybe an example in that regard is in the automotive finance space. 90% of our loan applications will decision within an hour, which is much faster than our competition. And that's one of the reasons some of our referral partners prefer to use us rather than other lenders. And it's really our technology that allows us to deliver such fast outcomes. The fact when we underwrite a loan, we don't have to ask the customer so much when we're going to so many different third-party sources for information, so we can make it a much more streamlined process for our referral partners and applicants. On to the next slide. Here's some highlights from our year to 31 March, obviously a COVID year, but things certainly moving in the right direction. Revenue over $50 million, and our cash NPAT, moving in the right direction quite quickly. And then finally, on the next slide, we talk a bit about our priorities here. I mentioned we've just hit a run rate in terms of loan originations of $1 billion in June. Our target of financial priority this year is to reach $1 billion loan book by March, which is our financial year end. The next priority is to achieve cash NPAT break even as a business prior to June next year, whilst investing in future growth. And then finally, driving our cost to income ratio from 55% in the last financial year to 35% over the medium term. In the last quarter, we made good progress towards each of these ambitions. So we think it's a very exciting time for our business with the growth we're achieving, the operational leverage inherent in what we do. And one thing we did update investors on in our quarterly results was the fact that we expect to issue our first term transaction, so to sell $300 million of our automotive loans into the term market. So again, increasing the diversity of our funding and reducing our funding costs, which we see as a bit of a short-term catalyst for our business. So that's the summary, Tim. I don't know if you've got questions flowing from that.
Thanks, Daniel. Good timing, spot on timing. What is your source of funding?
So we started with a focus on retail investors. We then introduced a raft of institutional investors, the government, and 8 different banks funding loans. But the majority of our loans now are funded out of 2 warehouse funding facilities we have, backed by one of the big 4 banks and some other mezzanine finance providers. One specific to automotive loans, the other specific to renewable energy and personal loans. And they represent about 80% of our funding. And the next logical step, once you're funding out of those warehouses, is to issue some term transactions where you can further lower your funding costs and reduce the equity that the business needs to provide.
And I mean, you're technology driven. Do you consider the banks competitors, or do you have some other competitors out there?
That's really specific to the verticals we operate in. If we think about the automotive market, we've actually seen a succession of banks depart that market. We saw ANZ depart that market when it sold its book to Macquarie some years ago. We've seen Westpac selling its book now. So the competition is partly banks, but also, there's a number of other lending businesses there. I don't think there's a business quite like ours in terms of, the emphasis on the technology, on innovation, in terms of constantly improving the product offering. And that's one of the reasons that we're really rapidly driving that growth. If we look at the personal loan market, when we started lending, a number of years ago, the banks had about 90% market share, the big 4 about 80%. That's declined quite substantially to the benefit of businesses like ours. I think when consumers think about getting finance now, they don't think about going straight to their bank for a personal loan, for example, or auto loan. They think to come to a business like ours, they'll look at product reviews, they'll search on Google, they'll go to a loan broker and take some advice. And these are all the places where we're relevant.
And I think you showed a slide there where your clients have a higher credit score than normal. Why is that relative to the banks? Is that part of your process? Is it process driven?
It's partly that. I mean, there's the bank population is a very large population in Australia, and we think that's where you need to be if you want to build real scale. I think in terms of why our credit ratio is a bit, it's partly by the nature of where we're lending. So renewable energy customers tend to be homeowners, tend to have a mortgage, they tend to be very responsible people. Similarly, in automotive finance, the way we've sought to build our distribution has been focused on those very prime customers. Similarly, in our personal loans, I think we've always sought to make sure we have a very strong credit track record. And one of the reasons for that is it comes out in your cost of funds. So, you can continue to attract lower cost of funds if you've got that strong credit performance. And we can use technology very effectively to filter out better who we do want to lend to and who we don't.
And can you talk to a little bit more about the renewable energy vertical? Obviously, automotive personal loans is a big part of the market, but why pitch yourself in that area of the market?
Well, really, the credit performance is quite exceptional. Our annual loss rate on those sorts of loans is well below 50 basis points. It's a pretty large market with a relatively small number of players in that market. We saw about 30% growth in solar installations last year in Australia. The uptake of batteries is increasing quite quickly. And as most people know, batteries are quite expensive, so it increases the spend for a renewable system quite dramatically when you also couple a solar system with a battery, and that increases the need for finance. So we see a real growth opportunity in that segment, and a real opportunity for us to work with some large corporates and other partners to build scale quite rapidly there.
And given COVID's so topical, it's a standard question, how's that impacted your business? And then can you talk a little bit more about where you see growth moving forward?
Look, it's interesting. In the June quarter last year, we actually had a record quarter in automotive finance and renewable energy. So we saw strong demand through that COVID period, and I think the same can equally. And personal loans, look, we did tighten our credit criteria and so on. So we quite deliberately withdrew our marketing spend and tightened credit there. But actually, in the last quarter, we had a record across all three verticals. And when we look forward, we see opportunities for growth in each of our verticals. Automotive is probably the largest opportunity, just given the size of that market. And similarly, in automotive now, and renewable energy, now we've launched a buy now, pay later offering, and coupling that with our personal loan offering or interest-bearing offering. We've got a fully featured sort of product set for people who are actually selling this equipment to people in their home. So they're probably the two that we would call out as having the largest growth opportunities in front of us.
And can you give us a little bit more colour on your distribution with the referral partners?
Yeah, so we've built quite a lot of technology so that we can integrate with referral partners, be they loan brokers or renewable energy installers, amongst others. It's all about making their job easy, allowing them to grow their business so that they can provide finance easily to their end customers. They'll care about different things, but often it's around making sure you've got a really fair, transparent loan offering that's got competitive rates. But often more important, it's how rapidly can you approve a loan application and service the end customer so that they can go and install the solar panels or sell them or let the customer go to the dealership and get their car. And often a loan broker, for example, in automotive finance is actually competing with a dealership that's offering finance. So they want to lock that customer in quite quickly. So the technology aspect and building, those really strong integrations with your partners is unbelievably important. It's obviously quite hard to do that if you're building off legacy systems, and that's where we see ourselves as having a real advantage as a sort of bottom-up technology-led sort of business.
Right, Daniel, that's all we have time for. Great story, exceptional growth. We look forward to having you back on in the near future.
Much appreciated, Tim. Thank you.
Have a nice weekend.
You too.
Next up, we have Intellicare, ASX code ICR, market cap around $16 million. 1-year return of -55%. The company provides smarter in-home solution, connecting families and helping seniors and people with disability stay in their homes. We have with us the Managing Director and CEO, Jason Waller. Jason, thanks for your time. Over to you.
Thanks very much, Tim. We'll go through to the next slide and to the next slide. Thank you. So IntelliCare, as said, we've got an AI technology using Internet of Things smart sensors that allows people to live independently in their own home. We've seen strong market trends in this area as baby boomers increase the pressure on traditional care providing models. And following a successful listing at the height of COVID in May 2020, we've started to really execute on our commercialization strategy, which fundamentally revolves around our software as a service or SaaS product. Next slide. This market has enormous macro trends. We've recently seen, following the Royal Commission and the federal budget, a massive increase in government funding in this arena. And this is reflected across all Western democracies, with President Biden recently committing $400 billion to their aged care sector, with the fundamental premise of trying to keep people in their own homes and out of residential care. Next slide. Since we listed, we've experienced great market traction. Our increase in installed units has gone up by about 18 times. When we first listed, we had about 25 units in the field, and that's now increased to about 450 units sold. We've expended 65,000 development hours, which is really the moat around our product and our IP. Next slide. In terms of the market, we're talking about not only the aged care market, but the disability care market. And combined, these represent about $40 billion of government funding, which is increasing. But alongside this, we're also tapping into the direct-to-consumer market. That is, those people who do not receive any form of funding and wish to fund their own aged care out of their own pocket, like the equivalent of self-managed super. Next slide. Unfortunately, this market stress is creating a lot of issues with traditional aged care providers. Residential care, which is what most people think of when they think about aged care, nursing homes, 51% are unprofitable, and the home care industry is finding it difficult more and more to create EBITDA per client. As I said, the government has tipped more money into this arena, but there is still an enormous number of people awaiting home care packages. Next slide. So the fundamental issue is that we have an increasing demand with a declining tax base. So therefore, people wish to stay in their own home and age in place. When they do that, the traditional technology they turn to are pendants and duress devices. Unfortunately, in 80% of the cases where someone has a fall, they don't use these devices because it's either not charged or it's not on them. But even in 30% of falls, they don't press it anyway because they don't want to tell their family they've got a problem and they're fearful of finding themselves in a nursing home. Next slide. So what we do is we install passive sensors. They don't require the resident to activate anything or to charge anything. They consist of movement sensors, power sensors, door sensors. And using our AI, we then build up a pattern of behaviour in that home. We look at when they get up each day, how much movement's around the house, when they're preparing meals, and whether they're socially isolated. And from there, we can send alerts out to families and caregivers when something's out of the ordinary. So not only do we have the ability to detect an incident that might otherwise trigger a loss of independence, but more importantly, using AI, we aim to prevent those incidents occurring in the first place so that we don't find someone too late. Next slide. So we built up a platform from the ground up where the core intelligence is at the passive detection level. We've also integrated then a range of emergency alert devices, including wearables such as smart watches and pendants. But we also have, on top of that, integrated devices like Fitbit and Apple Watch to look at vital signs and health metrics. So through this layered approach, we build a very holistic picture of how these people are living independently in their own home. Next slide. We then market that through 2 products, IntelliCare Pro, which is designed for professional care organisations. So these are the organisations that deliver in-home care and often also have a residential care business as well as the family-friendly B2C app, which is the IntelliLiving app. So that family members have the same insight as a caregiver to the professional caregiver and can become participative in that person's well-being. Next slide. We look at 3 or 4 core verticals. Firstly, those who are living independently in their own home. Governments are also a target of ours because reduced transmission pathways for COVID. And more importantly, it's a mechanism for them to reduce the overall burden of the tax base on aged care. And also hospitals, we're talking to them regarding how it can reduce readmissions, which is a major cause of concern for them because it increases the waiting lists. And lastly, with insurance, particularly in overseas markets, there is the ability to reduce their underwriting risk as their population and their client base ages. Next slide. As I said at the outset, it's a SaaS product, so we charge for the hardware up front, and then we also have an ongoing subscription fee. The hardware we market at about 34 to 40% gross margin, so there's room to manoeuvre and bring that down to increase market share. And also the subscription fee at scale is very high margin, 80 to 90%. So you can think of it a bit like the telcos, where they'll provide an affordable mobile phone or a smartphone, but they're looking to have ongoing subscriptions as their fundamental revenue base. Next slide. So through that, we market B2B through the aged and disability care providers. This represents about 80% of our business at this stage, and there's about 1 million people in Australia in this market. The larger market that we've just started to attack is the B2C market, and this is targeting direct to the end users, in particular the families, and it's 3 to 4 times the size of the federally funded market. And lastly, also through distributors and agents who have already an established market of selling into aged or disability care, particularly technology and assistive technology providers who might be providing mobility devices and other systems direct to both the consumer and also to our businesses. Next slide. As I said, we have recently really started to attack the B2C market in earnest. We created a marketing campaign here in Western Australia that went out through both television and radio, as well as digital and online. We saw an enormously exciting response, in particular to the TV ads. And you can see there was a direct response when we ran the ads. We expected this just to be an awareness campaign to boost awareness, with returns not really visible for 6 to 12 months. But in reality, we've started to get strong returns in the first instance as we started to convert those leads. Our marketing people described that they haven't seen such a direct response to a TV ad except for the MS Home lottery ads, where people go straight from the ad and then seconds later hit the website. Next slide. In the future, in our roadmap, we're looking really to move from that detection to prediction. So we are integrating next generation sensors and devices. We don't look to manufacture our own sensors. We're an open architecture platform, meaning we can strap on the best and brightest that are out there. In particular, there's a lot of movement in fall detection technology, which we've integrated onto our platform already. We've engaged the University of New South Wales and our own resources to increase our machine learning capability. So we're now starting to tap into this larger database, so that rather than using more coarse forms of artificial intelligence, we're using smarter and smarter machine learning to look at those patterns of behaviour and predict likely events in the future, and then for our carers to get in front of it. And lastly, integrating our system with EMR and case management systems of care providers, so that the outcome that they seek in terms of modified care plans is automatically in the workflow. Next slide. Our core management team consists of myself and the board that was restructured prior to the IPO. Greg and Mike are the co-founders, who are both still on board and significant shareholders. We have a significant pedigree of experience in both founding and exiting from technology. Next slide. So since listing, there's a lot of excitement at the height of the COVID crisis with our listing, but we've settled down since then. We still have board and management as a significant share base, and we recently raised another 2.5 million to start expanding on the East Coast, and we're recruiting to those positions right now. We recently recruited a Chief Revenue Officer to drive that growth. Next slide. So looking at the macro trends, this is a way for investors to gain exposure into that aged care sector. There's very few direct mechanisms for exposing your portfolio to that macro tailwind. I think the use of smart technology is going to become the norm in the future, and it's up to us now to grab that market share. Thanks, Tim.
Thanks, Jason. I suppose an obvious question is how has COVID impacted your ability to work with aged care homes?
It's been a real double-edged sword. So in the short term, the aged care industry is swamped by both the Royal Commission and COVID, so that reduces their bandwidth and their ability to engage somewhat. And of course, it's reduced our ability through, the same as everyone else, to travel to the East Coast, which is why we're recruiting on that seaboard. But more long-term, it's very positive because it has done two things. Firstly, it's demonstrated that residential aged care should be a safety net, not a destination, and that ageing in place is the preferred pathway. But secondly, it has accelerated the adoption of technology both within the aged care industry, but also by the elderly themselves.
And something like the National Disability Housing Scheme, which I've spoken to people about before, have you looked to work with the people who are actually building the houses to embed this your technology into that housing?
Yes, we have specialist disability accommodation, or SDA housing. It's very prospective for us, and we had our first success in Victoria recently, where we've installed 25 systems into SDA housing there, with the aim that the on-site carers can manage these people remotely rather than having to pop into the units all the time. Government is investing about $700 million a year into that type of housing. So it's longer term because you have to get in front of the development curve and speak to the developers at the outset of the project. But I think it's very exciting because the disability sector in general is a lot more receptive to technology and assistive technology. They're far more engaged than the aged care sector at this stage.
And ultimately, the data you extract from a nursing home or aged care facility and have those all around Australia, what sort of insights can you gain from that data from a commercial sense as well?
Fundamentally, it allows people to customise their care plans so that government funding is often linked to the level of care that person requires, and anecdotal and survey evidence is what's currently used to support and justify an increase in that plan, which means it's inefficient, so it's not aligned to the care needs. We find that each individual is different, but there are some consistent trends. So I think in the future, we would see through our APIs and our data lake, the use of this data to start to inform clinical research. So for things like dementia, cardiopulmonary disease, and frailty, there can be some clinical outcomes that are achieved by looking at our data trends.
And just finally, is there any lessons to be learned from kind of overseas, your peers and your competitors in those markets?
Absolutely. We see the markets as moving both in, say, the UK and the US and Canada in tandem. They're all coming to grips with what's going on. In the US, at times, 75% of the residents in a nursing home unfortunately passed away. So the boards of those organisations are very, very much now looking to the future at how they build out their new care models. They realise they can't do what they've done in the past. And so we're trying to tap into those, and expansion of those markets is very much part of our roadmap at the moment.
Great, Jason. That's all we have time for. Have a nice weekend. We'll get you back on again.
Thanks, Tim. Good to speak.
Thank you. Next up, we have Wellnex Life, ASX code WNX, market cap around $36 million. The business has recently been rebranded. The company is focusing on developing next generation health and wellness solutions. We have with us the CEO, George Karafotis. George, over to you. Thank you.
Thanks, Tim, for the introduction, and thank you for everyone for taking the time to listen to the story. It's been an exciting week for the company this week as we re-quoted on the ASX just like yesterday, after a long-term suspension as we restructured and repivoted the business to become a established player in the health and wellness market. So next slide, please, Tim. One after that. So Wellnex Life, we're an Australian brand and distribution company with a keen focus on the health and wellness market. But what makes us a bit unique is we have a really diversified stream of revenue. There's different sections of the business that adds to the bottom line, which is de-risk the business moving forward. Next slide, please, Tim. There's no doubt the health and wellness market globally is the fastest growing market in the world. In Australia alone, the market was around $5.6 billion currently, and it's estimated to grow to about $7 billion by 2023. And one interesting fact is on a per capita basis, Australian consumers are the largest consumers of vitamin products. So, and unfortunately for us, the COVID situation that's happened here and then globally has sort of been a boom for us, because as more attention by consumers on health and wellness and in their thoughts, the more demand for health and wellness products. So it's a really good time for us, and the way we've pivoted the business moving forward. Next slide. So what this slide shows you, it is the whole health and wellness market across all categories is increasing in sales and revenue. Of course, consumers are looking for new and unique ways in consuming supplements, vitamin products, herbal and traditional products, all sorts of things. So consumers are really looking for preventative measures over traditional medicine. So it puts the company in a very strong position to take up these opportunities that exist. Next slide. What's really exciting for Wellnex is that we've come back on the ASX boards with a business that's really established in the market. We have over 15 brands in our portfolio. Some of them are wholly owned by Wellnex, including the Organic range, the Little Innocents range. But what I really want to focus on is the future brands that we're bringing to market in the first quarter of financial year 22. One of the most exciting ventures is a 50-50 joint venture with Chemist Warehouse under the Wagner Liquidgesics brand, which will be Australia's first soft gel liquid analgesic range. What that sort of signifies to the market is that the credibility that we bring to the health and wellness space, where you have a major retailer like Chemist Warehouse want to partner with a company like Wellnex to launch a new brand. Now, the good thing about that brand is that Wellnex is responsible for the production and the packaging of that brand, and Chemist Warehouse is responsible for the sales and marketing of that brand. So it's really exciting. It's a low cost entry point for Wellnex, because obviously any brand company, the major expenditure is marketing, which Chemist Warehouse are doing. So we're really excited about that launch, and that's anticipated to be ready on shelf around September, October this year. But the other two products that we're bringing to market in the first quarter will be a range of iron and vitamin gummy range. It'll be Australia's first slow releasing iron gummy product on the market, and we've secured ranging for those products, and we have secured purchase orders as well. And another product that we're launching in October this year is a range of energy gummies and effervescent tablets under the Wakey Wakey brand. It's taking on no dose. It's a new and innovative way to consume an energy product. And again, that's secured ranging, and we have secured purchase orders for that product. But also, what we do, and it's a substantial part of the business, is that we represent a lot of international brands to secure them distribution here in Australia, which is a good revenue generator for the business and a very good and adds to the bottom line significantly. So you look at Compede and Simply 7 Chips, they pay us a service fee for us to represent their brand in the domestic market. So it just, again, shows the credibility of the company and what we've built over a period of time. Next slide. The company has been growing around 30% year on year on revenue, but we actively are looking for new growth strategies moving forward. That's going to come from increasing the brand portfolio. So we are currently working on some new brands and products to bring to market. But we can do that with real confidence because with our relationship with all the major retailers, including API, Chemist Warehouse, Coles and Woolworths, and the contacts we have in them, when we do release a product, we can almost be certain that we'll get that product ranged within one of those substantial retailers here in Australia. So again, that relation with Chemist Warehouse and that joint venture allows us the opportunity to be innovative and develop new products, knowing that we're going to get ranging within the major retailers here in Australia. We also want to build on our established distribution channels, but also expand on them. Currently, the business generates 90% of its revenue within the domestic market. So we don't do much sales internationally. And I think we can start looking ahead and sort of tapping those international markets to significantly grow our revenue and profitability moving forward. And one thing that our model does allow us is that we're a capital light model. We don't own any infrastructure. Everything we manufacture is outsourced. So we're able to have an efficient capital management plan and also deploy resources quite innovative way so we can capture the opportunities as they exist. So we're a capital light model and we're in a very good position to take the numerous opportunities in the health and wellness space. Next slide. So it's one thing being a brand and distribution company, but you've got to have the infrastructure and the competencies within your organization to be able to take the opportunities as they exist. We have major agreements signed with all the major retailers here in Australia, including Coles, Woolworths, API, Sigma, Chemist Warehouse, and so on. We have an experienced sales team. The head of that sales team is a gentleman called Zach Bozanowski, who was the founder of Brand Solutions Australia, the business that Wellnex bought. He was the co-founder of Boost Vitamins back in 2013, and only a couple of months ago, that brand was bought by Procter & Gamble. So he's been in the game for over 30 years in the FMCG space. He's got extensive contacts, extensive experience, and he leads a very experienced sales team underneath him. So what this acquisition of Brand Solutions Australia has done, it has brought experience and knowledge within the Wellnex family to grow our current offering, but also to expand our and also take advantage of future offerings moving forward. Wellnex also has its own R&D and marketing team as well, which is really, really important. So, you know, we can be ahead of the game in trying to predict what consumers want moving forward. And that's all done in-house, which is very cost effective and also more efficient. It allows us to turn around new product development, brand development in a much more quicker way than any other company could possibly do it. We've got key manufacturers who develop our products. We've had long association with them. We have numerous exclusivities with them. So we're very well protected in the products that we're bringing to market, that no one can go and sort of copy our products, which is really important to keep our uniqueness in the market. And we have a trusted supplier relationship. Again, we've got contracts and supply agreements with all the major retailers. The joint venture with Chemist Warehouse and that relationship is growing. We have a 10-year supply agreement for our organic infant formula with Chemist Warehouse. The revenues from that supply agreement is growing around 30 to 40% year on year. So, and that's sort of that relationships we have with suppliers is sort of borne out by the fact that, you know, these major brands internationally, like your Compeed, your Simply 7, use our resources to get distribution within the Australia market. So it puts us in a very good, strong position. Next slide, please. Future revenue growth. We are looking at the moment in numerous opportunities, both in new product development and brand development. We're also talking to some companies in regards to further expanding our joint venture relationships. And also some exciting developments will be shortly coming in regards to some licensing agreements with some prominent international brands. And obviously the company will also look for, you know, potentially acquisitions to that strategically fit to our existing brand portfolio as well. Next slide. This is what's really exciting for me as CEO of the company is the growth in revenue. We've had about 170% growth from financial year 18 to financial year 20. Financial year 22, we're looking at revenue of in excess of $22 to $23 million. As we're developing more of our own brands, what you'll see is an increase in the gross profit, which will we anticipate to be in a cash flow positive profitability by the end of financial year 22. We have a conservative capital management plan. Again, the biggest expense for any brand or marketing company moving forward is marketing. With the relationships that we have with all the key retailers, we are able to control that marketing spend and sort of leverage off the retailers' exposure or sort of marketing they have internally to get sell-through of our product within their network. So it's exciting times for the company. I think the opportunities are endless in this space. It's about trying to find the right opportunities and taking advantage of them. So I think the future is very bright for the company moving forward. Next slide. So in summary, we have a wide range of products in market already. We want to expand those product offering moving forward. We have the distribution channels. We have the expertise internally. And the most important part of all this, it's one thing bringing a product to market, but it's ensuring that product comes off shelf and goes into consumers' basket. We have a team that calls on 2,000 grocery stores and 3,500 pharmacy stores, which ensures the consumer and the retailer are educated about our products to ensure maximum sell-through. So that's really, really important. And because we're in the health, we're playing in the health and wellness game. That is, like I said, the fastest growing market globally. And then that's evidenced by the growth of the revenue of the company over the last 3 financial years, but also the growth plans that we've got coming forward for financial year 22 and beyond. Thanks, Tim.
Thanks, George. Can you go back a couple of steps and talk about the BSA transaction, which was the acquisition of the company that got Wellnex established? Is that right? Can you give us some idea of the terms in that?
Yeah. So we just to go back a little bit, Wellnex in its previous form was called Waddle Health, and we were we were an infant formula play trying to get out of vertical integration, and then the company sort of took a pivot and restructured its business, and then looked at the Brand Solutions Australia business back in September 2020. And what attracted us to that was its diversified revenue streams and growing revenue, both as its product offerings and its contacts in the industry. So we came to a agreement in April 2021 after a long due diligence period and coming to final terms. And the acquisition was done for $4.75 million, which was $2.75 million in cash and $2 million in shares at 15 cents. And future earnouts for the next 3 financial years based on EBITDA targets that the Brand Solutions Australia business must hit. So for them to earn a performance earnout, they'd have to hit a minimum EBITDA of around $900,000 for the next 3 financial years to get an earnout moving forward.
And would you describe it as a small margin business? You're dealing with the manufacturers of the product.
Yeah.
And at the other end, you've got the distributors who always take their margin. You've got big revenue, but perhaps small margins. Can you talk to that?
Yeah, I can talk to that. So the Brand Solutions Australia business was first established as a brokering business. And obviously the margin is smaller than a normal brand and marketing business. But what you'll find, Tim, is that as we're developing more of our brands and products that are wholly owned by Wellnex, is that your margins will substantially increase. Now, we've got an average margin currently of around 20 to 25%. We're targeting around 45 to 50% for our products moving forward. And the way we do that is that, again, it's about the innovative way we are developing our products. For instance, I'll give you an example right now. You can go today and buy a packet of No-Dose, which is a caffeine-based tablet, for about $9.95 on shelf. we are producing a range, a similar product in a gummy range. That product will sit on shelf around the $29 mark because it's an innovative way, it's a new way to consume a product. So instead of taking a tablet, you'll take one gummy and it'll give you the same sort of effect as that no dose product. So, you know, as you bring more products to market, your GP is going to increase. And one thing that's helping us a lot is that, for instance, the joint venture with Chemist Warehouse, that product is being sold and marketed by Chemist Warehouse at a good margin. Obviously, they've got a vested interest because they own 50% of that brand, which will increase our margins on our side as well.
Great, George. That's all we have time for. Good luck moving forward with your ASX listing, and we'll get you back on again.
Thanks, Tim.
Okay, next up we have Strike Energy, ASX code STX, market cap of around $615 million, 1 year return of up 56%. The company aspires to be a lowest cost onshore gas producer in Australia in order to ensure affordable and abundant natural gas is available to support the energy transition into a lower carbon future. We have with us the presenter, Stuart Nichols, who is both the MD and CEO. Over to you. Thanks, Stuart.
Yeah, thanks, Tim. And thank you very much, ShareCafe, for having me on the Hidden Gem section today. So Strike is not only just going to be a natural gas producer, and it's also going to then look to integrate that natural gas into Australia's largest source of its own domestic fertiliser, as well as integrating renewable energy through its geothermal assets in the Perth Basin. So if we could just jump forward. As you can see from this picture here, Strike's one of the most exciting investment opportunities in the energy space in Australia at the moment. And that's because over the past several years, we've compiled a series of assets where we have built a strategy by a world-class board and in a very confined and concentrated jurisdiction that can see the company worth multiples of its current valuation. And that comes off the back of discoveries of low-cost natural gas resources in an area of the Perth Basin that we like to call the Permian Gas Fairway, or in the far north where our West Erregulla field sits. On top of that, we've also acquired some 3,500 square kilometres of the only geothermal rights in the Perth Basin, where we are quickly de-risking Australia's only baseload 24/7, 365 renewable asset. And we're looking to monetize some of our future volumes of natural gas through our fully integrated fertiliser development up in Geraldton, where we've been given 60 hectares of land by the state government here in Western Australia for a 1.4 million tonne urea fertiliser manufacturing facility. So as we move to the next slide here, what I like to call the Strike complexigram. And this is this nested and integrated strategy, which is actually quite simplistic. When you move to the far left of this picture, you can see Strike's core competency really is in two fields. And that is in the identification, mapping and interrogation of Permian Kingia sand units of the Perth Basin, and then drilling holes into it. And if we drill holes into it, then it's the extraction of either the gas or the fluid in which sit inside those sand bodies. And that gives us a proliferation of opportunity. It's not just domestic gas, as you can see in the bottom arm of the development, where we will be looking to take FID on our maiden 87 terajoule a day development at West Erregulla in the coming months, but also taking that natural gas, which is a major feedstock for cost competitive fertilizer, urea fertilizer at that, making hydrogen and ammonia, and then also distributing that fertilizer around Australia. But that core skill also allows us, through the mapping of Kingia sand units and drilling holes into it, to also interrogate and hopefully commercialize what we can see as up to 350 megawatts of zero carbon baseload dispatchable renewable geothermal energy. That could be done on industrial scale, and that could have the impact of actually removing a coal-fired power station from the West Australian economy. So that's quite a meaningful opportunity for us at this point. But moving forward and to the next slide, when you add all of this together, back to took my crescendo there away, back to the net zero would be great. When you add all this together, the Strike strategy culminates in being net zero scope 1 and 2 by 2030. This is the most aggressive and ambitious net zero target of any energy manufacturing business in Australia. And it's something that we can do through our contemporary nature, our innovative use of our natural gas and green hydrogen sources into the fertilizer development and the proliferation of geothermal energy in Western Australia. 2030 is held up as the benchmark by Fortescue as the yardstick for decarbonisation programs. We're looking to meet that. And we're also looking to do that from being an energy company, which often has a fairly high carbon footprint. As we move into our domestic gas business, the next slide now, and then we'll jump straight after that one. You can see where the nucleus of the value of the company currently sits. The company is currently trading on its domestic gas business value really only. What we have done is we've discovered a major conventional gas field, one of the largest conventional gas fields ever found onshore Australia in West Erregulla. It was one of the deepest wells ever drilled. That field is now well appraised, and it's giving us the confidence to continue to explore into the Dandaragan Trough to the southeast, where you can see Strike's permits into South Erregulla and into our other various opportunities. The North Perth Basin, between the discoveries of Waitsia, West Erregulla and Bahara Deep, is putting together a very impressive track record of success, where all 15 penetrations of the Kingia Sandstone to date have found commercial conventional quality reservoir, and 9 of the 8 deep wells drilled have been the foundation of conventional gas discoveries. So between ourselves, Beach and Mitsui, Rystad are currently estimating that up to 10 TCF of some of the lowest cost gas in the region would be discovered in this part of Australia. This would be gas on cost that would rival Qatar, Russia, and the US, and gives us a great opportunity to use that cost base to start to wrestle back some of the products that we've offshored into other manufacturing jurisdictions. Next slide, please. And you can see some of these results here. We've been drilling since September last year, and we're very pleased to point out that the West Erregulla gas field has consistently supported strong commercial results. We've recently flow tested the West Erregulla 4 well, which had a strong 35 million standard cubic feet a day flow rate with no depletion evidence on that 46-hour test. We did produce a small amount of fresh water, which was part of some of the discussions earlier in the week through various ASX announcements. And we're very confident that that water is actually being produced through a small perched water lens sitting against the Bitbasher Shale, and is actually not diagnostic of a water contact in the field. We'll be able to prove that very soon in the perforations and the flow testing of the West Erregulla 5 well, perforations should occur on Wednesday or Thursday of next week. And then we'll look to start flow testing West Erregulla 5. We're looking for an equally strong commercial flow rate from that well, and that should give us the foundation to be able to move ahead with the resources and reserves required to be able to commercialize the phase 1 87 terajoule a day development. Moving ahead, you can see what this development looks like. It's actually quite prolific, and we'll see Strike rise to becoming one of the largest domestic gas producers in Western Australia by the end of the decade. While starting with 87 terajoules coming from the West Erregulla gas field, we will look to monetize our Erregulla complex, or the greater Erregulla structure, to scale up our gas production to some 316, maximum of 316 terajoules a day, which is what the export pipeline is sized for, from the gas plant to the Dampier-Bunbury natural gas pipeline. Australian Gas Infrastructure Group will be building, owning and operating the gas plant, and we'll be providing the capital base for that large piece of infrastructure, and that will be underpinned by long-term gas sales contracts between ourselves and our partner with Wesfarmers and Alcoa. Moving to the next slide. But we recently told the market about a very transformational second half of the year that's coming up. And that's because we're about to take the confidence that we've had from the West Erregulla appraisal campaign and start to move south. And you can see in this visualization of the 3D structures of the greater Erregulla complex is that we're about to move into South Erregulla, which is a very large regional high for the area. In fact, it's actually the top of the structure sits shallower than West Erregulla. And we'll be putting a well into that in October of this year, where we believe that we can uncover a greater than a TCF of future recoverable gas resources. Even under the most conservative assessments of where the water contact at West Erregulla lies, South Erregulla still sits comfortably above that contact, and in fact would still be a very robust commercial gas resource, rivaling West Erregulla in total size as well. Moving to the next slide. But our domestic gas business is actually improving in value every day. 2020 was a tumultuous year for domestic gas in WA because it's been heavily reliant on investment from super majors and Australian oil and gas majors. What we saw last year were 3 major domestic gas projects delayed because of their parent companies' LNG projects being delayed. We saw Gorgon Phase 2, Scarborough and Browse ultimately be delayed or deferred. And that also then came in parallel with 165 PJs written off from Santos's domestic gas portfolio, where they are one of the largest domestic gas producers in the state. This lack of reserves replacement is coming as a looming mid-decade undersupply. And that is then compounded by the fact that domestic gas usage is on the rise. We're seeing APA's Northern Goldfields Interconnector pipeline connect the Perth Basin through the DBNGP across to the Goldfields, where we believe there's 120 terajoules a day of salient domestic gas demand that's about to come forward, as gold, copper, nickel, and iron ore producers all start to try and reduce their carbon intensity through the reduction of diesel-fired electricity and the increase in gas consumption. This has all come together as a confluence of events that has seen the domestic gas price rise to north of $5 on the spot market so far, and over 120% in just 12 months. Moving ahead. What are we going to do though if we uncover very large sources of natural gas in the second half of this year? Well, the Strike's board of directors decided that we would like to move ourselves down the value chain. And as we move to that next slide, you will see Project hHidden is that aspiration. We have been received 60 hectares of land in the strategic industrial estate of the Narngulu area, which sits out the back of Geraldton and is connected to the Geraldton Deepwater Port, the state's rail and road infrastructure, as well as having a nearby airport. Project hHidden is a 1.4 million tonne urea development production facility, which will see the large proportion of Australia's imported fertiliser displaced with domestic sources. We'll be able to get our own agricultural critical commodity supply source coming from this development. It will displace more than $1 billion of imports, over what 10% comes out of China. It will not only reduce the cost, structurally reduce the cost of broadacre farming in Australia, but it will also have a meaningful reduction on the carbon intensity of our farming and our urea consumption. And it will see the integration of some of the first green hydrogen into a dedicated fertiliser development, and we'll be leading that charge right here in Western Australia. We've had ACIL Allen, a highly reputable economic modelling agency, conduct our economic impact assessment for us. And in good news for Australia, this project will develop some $8.4 billion of GDP, will develop 1,500 jobs for 3 years of construction in the mid part of the decade, and will create 300 full-time jobs for 30 years in the Midwest region. It will see the Midwest economy grow at an accelerated rate of 3.8% per annum as a result of the size of this development. And that's all comes off the back of low-cost, affordable natural gas, which we can integrate as we move to the next slide with the region's vast 900 megawatts of renewable infrastructure that currently sits producing negative to zero price electricity in the evening. And that's because the Midwest wind continues to blow, and unfortunately there's not industrial electricity demand at that end of the Southwest interconnected system, which the Midwest is connected to. And so we're looking to not only use the wind and solar infrastructure in the Midwest, which generates very low cost power, to create 2% of our hydrogen feedstock as green hydrogen, and therefore integrating into our overall fertilizer development as being one of the only sources in the world of green fertilizer, but also the green hydrogen developments of our peers in the immediate region. We've seen ATCO receive ARENA funding for their development of their Clean Energy Innovation Park at the Badgingarra Wind Farm. We have BP developing a green hydrogen source right next door to Project Haber, and there are other various proponents in the area. And as we move to that next slide, you can actually see when you start to add up a lot of these impacts between the domestication of our supply chain, the use of modern ammonia manufacturing technology, clean Perth Basin natural gas, and 2% green hydrogen, we can actually start to reduce the carbon intensity of the urea consumed on our broadacre farms throughout Australia by 50% per tonne that we supply. And as we start to aspire to put up to 20% of green hydrogen into the plant, we can actually reduce that down a further 11%, down to 60% reduction in carbon intensity. And that is, when you start to add all of this together, you can see the meaningful impact that Project Haber can have on the fertiliser footprint and carbon footprint of Australia. We've got some really exciting developments occurring. We've got pre-feed completing in September with potentially the announcement of an additional technology choice, which could further enhance the carbon reduction of this fertiliser. Our second round of offtake for the project completes today, and we're expecting strong feedback from a lot of the industrial urea distributors and traders that have been involved in the project to date. And we've got strong interest from a lot of those off-takers for potential equity participation or even role as operator. Moving to the next slide. But that's, like a good Demtel advert, there's still steak knives to come. So as we jump through our Midwest geothermal power project, this was almost by accident that we stumbled into realizing that our gas assets were actually co-located with what we can see is up to 350 megawatts of zero carbon energy. It took a fat-fingered reservoir engineer who accidentally converted their reservoir model from a gas permeability to a water permeability that made our eyes stand out on stalks. We realized that the Kingia sandstones, these deep Permian permeable sandstones that sit at great depth, in a sufficient depth to have a strong geothermal gradient, are actually host to water resources if you drill off the gas-bearing structures. We believe that you could free flow one of these wells at 13,000 barrels a day of water at greater than 150 degrees or so, which would give us the basis to produce some of Australia's only base load renewable power. Now, we've got 3,500 square kilometres of this acreage. We own 100% of the geothermal rights in the basin, and we will be the frontier and front runner of this exciting geologically driven technical development. We've just had the West Erregulla 4 flow test, and as we move to the next slide, occur, and that West Erregulla 4 flow test produced a little bit of water to surface. That water was sufficiently hot enough in its very small quantity to heat our wellhead at West Erregulla 4 up to 115 degrees. Now, there was predominantly gas flowing through that well, and gas is a poor thermal conductor. That small amount of water was sufficiently hot enough to bring the wellhead to a point in time where we believe that we've slightly de-risked the geothermal play. Now, as we add our geothermal aspirations together, along with our fertiliser development and our domestic gas business, you can see a very deliberate and thought out pathway to being net zero 2030, certainly in scope 1. And if we can aspire to industrial scale geothermal electricity, we're going to chip away at our scope 3 as well. That's something that no one is tackling in Australia to date, and would really put Strike out in the forefront as being one of the most carbon conscious, zero carbon natural gas, fertiliser and electricity producers in the country. So when you add that all together, that's a very ambitious plan, but we're starting to chip away at it every day. And I'm really excited to see the developments that have occurred this year. We've bolstered the team. We've recently brought in some new executives out of Wesfarmers to help us realise our aspirations. We've raised the best part of $100 million in new capital, and we're just about to take FID on our maiden gas project, which will see first free cash flows delivered into the business in early 2023. So in regards to all of that, that would be the end of it. Thanks, Tim.
Thanks, Stuart. A lot to get through there, so thanks for your time. You've had a couple of announcements this week. Originally, there was a kind of a difference of opinion, if you like, on with your JV partner, Warrego Energy, on the significance of water in some of your test results. Can you give us a better understanding of where does that interpretation between the parties now rest?
Yeah, look, I'd like to think I'm a fairly reasonable person, Tim. I'll always compromise in negotiations on time frames and on developments and things like that. But what I will never compromise on is technical fundamentals. Technical fundamentals are the basis of our core competency, in which the strategy that I've just rolled out in front of you. Ultimately, Strike couldn't piece together how the production of very fresh water, small quantities of water that was seen to decline during the West Erregulla 4 flow test were the indications of a field-wide gas-water contact. Now, this was not a interpretation shared by our joint venture partner, and unfortunately, at that point in time, it resulted in differences of opinion and different announcements at the start of this week. We have also published new information today, which shows just the coherent and consistent application of the regional data, the data from the play, the analog fields of Waitsia and Bahara, and how we've come to our technical conclusion. And ultimately, the proof will be in the pudding next week when we perforate West Erregulla 5 and flow test that well.
And a quick technical question here, if we've got an oil and gas analyst online. If the 100% owned South Erregulla well is successful, could it leapfrog a West Erregulla development?
Between ourselves and our joint venture partner, we've committed to the long lead items of the West Erregulla phase 1 development. So that development, given the gas is sold to both Alcoa and to Wesfarmers, and we've made such great progress in the last year and a half, there would be not a good use of the company's time and energy. However, I definitely could see, given how long it's taken to get that first piece of the puzzle together, that the South Erregulla development could be the basis of the scaling up of our domestic gas production in Western Australia.
And just finally, you spoke about the increased gas demands, and obviously funding in this sector from an environmental ESG principle is perhaps potentially lacking in the future. How do you see this whole cycle playing out at the moment for a gas company like Strike?
So the use of gas in Western Australia is actually supporting the proliferation of more renewable energy. Gas provides a good feedstock for dispatchable instantaneous energy for when the wind's not blowing or the sun's not shining. So in partnership with renewables, we see it as a valuable energy source as we start to transition into new forms of energy or energy storage to get and help those costs come down. Natural gas is also a big part of our hydrogen aspirations. Unfortunately, you can't make globally competitive fertilizer right now just on green hydrogen. You may be able to do that in the future. And that's exactly why we're using our natural gas at the moment to help us build the infrastructure, that 1.4 million tonne fertilizer development, which will position Strike very positively as that transition starts to occur, as green hydrogen becomes cheaper and we can start to displace our natural gas with more green hydrogen and ultimately make pure green fertilizer. So really, gas is a great transition fuel. We're seeing still very positive supporting from debt institutions like Australian retail banks and international investment banks. And also the equity markets continue to be supportive if you can show a logical pathway to a net zero, a net zero pathway. And I think Strike has one of the most credible and honest approaches to that. It's very contingent on some project success, but it is exactly how we see the strategy rolling out, and it's our commitment to our shareholders. It's such a commitment that I've actually linked 30% of my bonus remuneration to achieving that net zero target and progress year on year to it.
Great answer, Stuart. That's conviction for you. Thanks for your time. Great presentation. We'll get you back on again. Have a nice weekend.
Thanks, Tim. Thanks, ShareCafe. Bye.
Thanks, everyone. That's all we have time for. Enjoy your lockdown. See you next week.